Hi, and welcome to another Rebound episode of Baranov TV, designed to help your business come through coronavirus as strongly as possible. In this module, we're also still talking about cash, as we did in the previous episode, which is all about tracking the cash in your business and monitoring your cash flow. But in this episode, we want to talk more about cash improvement and making sure that your cash is working as hard as possible for you in your business and you're holding on to it and preserving it as much as is possible. So we've already established that preserving the cash is going to be really important as we come out of coronavirus. It may be that with your bounce back loan or your CBILS loan, it's helped you to survive, but now you need to look forward. And a lot of people have been able to use at least some of one or other of those loans to actually enable them to look forward and to plan for the future. And having some of one of those forms of cash sitting in the business as a form of safety net is a really good idea. If you've been able to preserve that, then that's really good going, because it will enable you to be able to respond to any opportunities that may come up. And we don't know at this stage how the economy is going to look and what your particular market is going to look like. And if you can preserve some cash to give you that ability to be agile, then that could be a really positive thing for the future. So the first thing to do in your action plan in terms of cash improvement is to look at your cash conversion cycle. Now, the cash conversion cycle at its simplest is looking at the delay between cash going out of your business and cash coming into your business. And ideally what you want to do is bring those 2 points as close together as possible, because that is essentially your working capital requirement. So what you want to do is minimize that as much as you can. So it's all about the timing of the cash movements in your business. And that's what you want to really start by looking at. As you can see from the graphic that we've got here, which is an example of a cash conversion cycle for a product type business, the cash leaves the business when the goods are bought and only comes back in when the customer pays for those goods. So the cash in this example is actually out of the business for a total of 60 days, which is a long time. And the goal is, as I say, to reduce that as far as possible. Now, in this case, it may be possible to agree supplier terms that mean that you don't have to pay the cash out as early as you do. It could be possible to find a way of getting the customer to pay earlier, therefore perhaps giving them less than 30-day terms. So far, so obvious, but there are also some other opportunities to reduce that timescale, particularly within a service business. So for example, you could consider stage payments or deposits. So you're actually getting the cash into your business earlier in the cycle. The huge benefit here is that if you are obtaining payments earlier, i.e. before the service is performed or the service is finished, then you do have some leverage, which may be particularly important as we go forwards, because we don't necessarily know that all of our customers are looking at their businesses in the way that we are and making sure that they are robust to move forwards. So we may find that some of those customers whose business we're taking and for whom we're working may not actually be there long term. So we need to make sure that we're securing our own future and getting those funds in as early in the cycle as we can. Think about your terms, because we talked before about trying to get those customers to pay earlier. It may be that actually you could have different sets of terms for different sets of customers. So if you are providing a service to domestic and commercial at its simplest, you don't have to have the same terms for both types of customers. You could have a domestic set of terms that are entirely different to your commercial terms. Similarly, you might want to consider having different terms for new customers as compared to long-standing customers going forwards. As I said before, we don't necessarily know what financial health our new customers are going to be in. So we may want to look at those slightly differently. We want to make sure that we're protecting our businesses. So also you might want to think about the methods that you use to collect payment from your customers. So there's cheque payments, they are still in use. There's bank transfers, there's direct debits, there's standing order, there's credit cards, all of which give you different flexibility and different levels of protection, and they come through in different ways. So there's no prerequisite that every customer has to use the same payment method. And there's no prerequisite that you have to come out of lockdown using the same payment methods that you went in using. So it may be that for every new customer you say direct debit. It may be that you say every customer, no more cheque payments, it's got to be bank transfer, and it's got to be bank transfer before we release goods, whatever it may be. The one thing that we do know is that there is far less resistance amongst your customers than there is in your own mind for a change of payment method. So really do think about what you would like to move to and start to use that for new customers at the very least, because that will be your gauge as to whether it is possible to use it. If you're not sure, pick up the phone to a few customers and ask them. In our last business, we used to do a mix of direct debit, standing order, cheque and bank transfer. In this business, we solely do direct debit and it's never been a problem. So really do think about it. It does put you in control and it gives you more flexibility, as I say. Also think about stock levels. One of the big payments out that a lot of businesses make is to buy their stock in. Going forwards, it may be that you want to actually keep less stock in the business, because that is a huge way, or a way of tying up a huge amount of funds within the business. It may be that you don't necessarily need to carry as much stock going forwards as you have done previously. Another thing to think about is Invoice Finance, which historically used to be a bit of a bad, at least have a bit of a bad reputation as sort of a last resort, if you like. But these days it's not of the same ilk. People don't think of it in the same way, and it is a lot more flexible than it ever used to be. So it's worth considering, particularly if you work for large customers or large businesses where their payment terms are lengthy. Invoice Finance might actually make it worthwhile in taking that route, because it would get the money into your account far sooner. Looking beyond the conversion cycle, there are other areas to consider, some of which we talked about way back at the start of coronavirus, in terms of the big expenses that you're making and just challenging every outgoing that you have within the business and looking at all the methods of income that you might have. So the big one at the moment that a lot of businesses are considering is whether they really need an office. We've all proved that to a great extent, many of us can work from home, whereas we would never previously have thought it possible. But with the current technology, you really can do it. Now, if you have a lot of apprentices, for example, it may not work for you because they absorb information like sponges and need really to be in that environment where there's a lot going on around them, and they will overhear and they will learn. But it may be that you don't necessarily need an office as large as the one you've already had. If you've got members of the team who actually would prefer to work from home on a part-time basis, you may find that you can actually have a much smaller premises than you have done previously. And that could be a massive reduction in what tends to be for most businesses one of their major outgoings on a regular basis. Think about your staff structure. A lot of businesses, again, we've been speaking to various HR advisors, and a lot of them are getting an awful lot of requests and a lot of questions about restructuring. People have decided that actually they can't guarantee that they can keep all of the staff that they've had. It may be that actually what you want to do is improve your staff retention going through this. You may have realised that actually you do have key members of your team that you absolutely want to hold on to because they're key to your business. If that's the case, it's going to be much more effective to invest in those relationships and really try and tie them to you than it would be to go through the costs of recruitment and onboarding, particularly in a time where the business may be under pressure anyway. So look at that side of things. And again, as I say, potentially the restructuring side of things. If you've identified that actually your business has coped really well with some of your team on furlough, you may want to just investigate whether you need to bring all of those people back. It's a really harsh way of looking at it, but the purpose of these modules and these resources is to ensure that your business survives the coming months, and that you need to make sure that you put the business first, unfortunately. The other things beyond that is thinking about whether you can outsource some of the functions that you've previously had internally. Can you improve your customer retention rate? Because it's much easier to hang on to the customers that you have than it is to constantly be bringing new ones in and have that constant churn of clients and customers. Can you think about cross-selling or upselling to existing customers, because increasing the value or the frequency of those transactions will help the business significantly? Can you improve your customer journey to tie the customers to you and to remind them of what the other things that you can do, and to just nurse them through the process a lot more? Or can you make sure that you can improve your follow-up processes so that when you do get a lead or an inquiry, you're improving the chances of those people popping out at the back end of the process as a proper customer, rather than sort of falling away along the wayside? Also, obviously, review all of your spends, all of your existing supplier arrangements and all of your regular payments to make sure that you do actually need them. Those subscriptions that you pay for every month, are you using them? Can you just grab the information, the value that you need from them, and then curtail them and cancel them? All of these things and all of these suggestions will have a direct influence on the cash position within your business, which obviously you'll all be tracking from the last video, whether that's using the spreadsheet or one of the Fluidly options. But whatever you do, it will make sure that your cash is working as efficiently and as effectively for you in your business as possible. And it will make sure that you are actually seeing the return on the investment of the cash that you've got in your business. A profitable business, sadly, can still suffer at the moment and can go under if they haven't got any cash. If you do have some cash, then you can potentially get your way through this, and if you are really careful about how you're using that cash. Also, statistically, more businesses fail as we come out of a recession than do during. And that's because they overextend and they get too focused on the day-to-day, and they lose sight of controlling the cash in their business. They put too much pressure on themselves and on that cash, and the business suffers potentially fatally. So there are other elements to consider within this process, but those actually are too large to cover off in this video with all of the ones we've already covered, and we will be doing a couple of those separately. So those are things like pricing and debt collection. Obviously cash flow we have talked about previously, so if you haven't looked at that yet, please do go back and look at that. There was a real reason why we made that the first of our resources. So work through all of the points that I've given you. There are others besides, but I think we've covered off the most important ones in this episode. As ever, if you've got any questions or anything particular to your business, then please do get in touch. All of these points are purely generic, but they would give you a good start in order to make sure that you're looking after your cash. I'll leave you with all of those, and I'll see you very soon.